Good afternoon, everybody. This is the Mastering the Art of Portfolio Construction panel. We're going to spend about a half hour together, so we're going to get right into it. We'll start with names and introductions of organizations. I'll begin, and then we'll just go down the line. My name is Anthony Novara. I'm a partner and research director at Fiducient Advisors, headquartered in Chicago. We advise on about $330 billion of assets under advisement to a variety of different client types. I wear two hats at the firm. I lead our hedge fund due diligence effort, and then I also lead what we refer to as our capital markets team, which is responsible for our asset allocation framework.
Hi, my name is Paul Chai. I'm the Chief Investment Officer at the Kansas State University Foundation. What makes Kansas State University special is our commitment to provide affordable, accessible education that changes lives of students from rural mid-America. So my role involves overseeing investment strategies and managing the endowment portfolio in support of our university's great mission as well as long-term financial stability.
Hi, I'm Anne-Marie Fink, and I head up the Private Markets and Funds Alpha division for the State of Wisconsin Investment Board. So we manage the public pension monies for the state of Wisconsin. And what Private Markets and Funds Alpha is it's all of our external managers, and it's about half of our $150 billion portfolio.
Michelle Knudsen, I'm the Chief Investment Officer at New York University. For those of you who don't know NYU, we're one of the largest private universities in the US with north of 60,000 students across campuses in New York, Abu Dhabi, Shanghai, amongst others. My office oversees the university's endowment, which primarily goes to support financial aid and academic programming for the institution. And we have a team of 10 people that invest a multi-asset class portfolio primarily through partnerships with external managers.
Afternoon, Darrel Pfeifauf with Advocate Health. We're a hospital system across 6 states within the U.S., 2 regions, the Southeast and the Midwest, so Chicago, Wisconsin, and then several states in the Southeast. Headquartered out of Charlotte. We serve over 6 million people, patients, every day across nearly 70 hospital systems or hospitals in those regions. My team, we're 16 people. We're actually spread out. Most of the team is in Chicago, but we're kind of all in a remote structure.
Well, great. Let's kick off with Michelle. The due diligence process has changed quite a bit in the last decade or so. What have you observed about the changes, and what resources are needed to be successful in your due diligence process?
Yeah, I think the expectations of allocators has changed a lot in that time period, with the big kind of summary change being we're held more accountable for the returns and the risk in our portfolio. I think this is simplistic, but 10 plus years ago, you had an asset allocation and then you just picked good managers, and there was not as much thought to, hey, what happens if we have overlapping strategies or if we have overlapping positions amongst our managers? As long as you had partnerships with investment managers that you thought would be good stewards of capital, that was sufficient. And as we've gotten smarter, and as our boards have gotten smarter, and as we have learned how to disaggregate different investment strategies to understand the positioning of the underlying portfolios, the onus is on the allocator more to control the risk in our portfolio. And I think what we've learned is that the incentives and the structure of what makes sense as a single line item in somebody's portfolio is very different than what we need to see when we think about the aggregate. And so that ultimately leads to needing more transparency, right? We need to have a better understanding of how our managers are investing their portfolios, how they behave in different market environments, and the market environments have been changing more quickly, and so we need to have more real-time information. And that's led us to construct our portfolios in a way that is much more in the weeds than we've had historically, and that means that our managers have to provide us a lot more data, and we need to be able to have the tools to crunch it.
Makes sense. Anyone else?
So I would say great financial crisis back in 2008 was a watershed moment for operational due diligence. The collapse of Lehman Brothers obviously exposed the need for enhanced counterparty risk management, asset segregation to ensure that you have limited exposure to any singular custodian relationship. And then the Madoff scandal obviously exposed the need for better transparency as well as independent verification of service providers. I would say 2020, the COVID pandemic has also been a significant moment in many ways for smaller institutional investors with limited travel budgets like ourselves. In that, one, the accelerated technology to move everything virtually, the ability to be able to conduct virtual meetings with fund managers anywhere, anytime, as well as the access to virtual data rooms provide the opportunity for a manager, investor who may not be able to travel as much as somebody who may be based in New York, the ability to be able to underwrite and conduct initial due diligence in the earlier stages in a much more scalable way. And secondly, I'm not paid to give the plug, but I would say there's also a proliferation of platforms like iConnections and Ted Seide's podcast, Capital Allocator, or virtual communities on messaging apps like WhatsApp that have truly breached the knowledge gap between large and small allocators and also democratize the access to various fund managers. So obviously not paid to do this, but I would say the iConnection conference has been instrumental resource for us in terms of manager sourcing.
That's good to hear. I would echo that as well. Anne-Marie or Darrel, anything to add?
So the thing I would add, echoing what Michelle said about more transparency, is the one thing that we're seeing is traditionally there's been a fair amount of quantitative analysis when we've looked at hedge funds or publicly traded strategies, and historically the private strategies have tended to be more qualitative. The qualitative is still important in the private strategies, but we're starting, as we get more transparency, to be more quantitative and looking at things like PMEs and various quantitative factors to determine what's driving a portfolio return. So that is a trend that I think we will be continuing to lean into.
I'm going to just pile on that one for a second, which is, I think also given kind of some of the regime change that we've seen in the markets recently, even going below the fund level to the company level in our private portfolios and looking at the economic performance of the underlying portfolio companies of our private equity and venture managers has started to become an increasingly important measure that we're looking at, not on a quarter by quarter basis because it's not so meaningful, but certainly on a year to year basis.
Makes sense. All right, let's go to Paul. So many managers seek as much transparency from allocators as they can get about their approval process for new strategies. Are there any hot button issues on which your investment committee or board tend to focus?
So my team is actually given full discretion over manager selections. So in this sense, we are slightly more flexible in terms of the ability to underwrite and allocate to managers to our portfolio in creative ways, even though we have a top-down strategic asset allocation framework. With that said, when you boil it down to, we're really trying to answer two major questions whenever we underwrite any new managers or strategy. Why is this new strategy a accretive addition or fit to our portfolio? So this has a lot more to do with our situation, our current portfolio needs, and how does this investment fit with the rest of the investments within our portfolio. And secondly, the question then becomes, why is this fund manager the partner of choice for this specific investment opportunity? And that's when we actually get into about the managers, about whether we like the person, whether the manager has a competitive advantage in this strategy. So oftentimes we have to say no to most of the great managers we meet, not because of anything wrong with the fund managers, but primarily it's really with our inability to be able to fit all the strategies within a portfolio that's relatively stabilized and optimized.
Makes sense. Anyone else offer either board or investment committee?
It's a little different from investment committee, but it goes along with that. We've found it very valuable to really understand who our partners are, specifically in private asset vehicles. It really doesn't matter too much when things are going well, but when you do have a situation, we've interacted with those before. Being on the LPAC, knowing who your partners are, and having communication with them along the way before you hit those situations has been really, really helpful. So that's within our investment committee, that's a it takes up a large portion of our time and conversation.
I would just echo one thing that when we speak with our investment committee, really important is just, Paul already mentioned operational due diligence. It's extremely important. If our investment committee gets hung up on one thing, it's what's the magnitude of our concerns on the operational due diligence front. It's something we do internally and think is really important. So if there's a little bit of, no operational review is perfect by any means, but there are some elements of operational due diligence that our investment committee would just say, if you have a little bit of concern, we'd like to choose a different manager or maybe not do this allocation at all in some cases. So I would echo that one as really important.
We also spent a lot of time thinking about incentives, and as I've gotten more and more experienced, I have come to appreciate much more the value of the alignment of interests. So we spent a fair amount of time thinking about that as well, both across the manager, the GP overall, but then also individuals within the GP and thinking about what their alignment is.
Yeah, very important. Back to you, Anne Marie. We'll start with managing liquidity is paramount to success when balancing various competing objectives. How do you think about the trade-off between taking on illiquidity in your portfolio in hope of achieving higher compensation via higher returns?
It's an interesting question because I have a slightly different view than some of my colleagues.
Great, let's have it.
And I mean my colleagues back in Madison, Wisconsin. Liquidity, I think liquidity can cut both ways, right? It's a knife, basically. And the knife can either help you to make a beautiful crudité, or it can cut your fingers off, right? So you have to be very conscious of liquidity, right? The last thing you ever want to be in the world is a forced seller. But outside of that, we don't find there's a lot of, now again, some of my colleagues feel differently about this. There are certain advantages to not being able to sell when things get really cheap and people are panicked. So we like a balance is the long and short of it. And we're in the fortunate position of we're about 30% in illiquids right now. And we're on a journey probably to get to about 35. So during the most recent concern about liquidity, we've actually been more of a buyer than a seller into that. So that's been fortunate.
How about you, Michelle?
So I think I would agree from the perspective of, I think a lot of institutions overvalue liquidity in their portfolios. There is a lot of value to having a fair amount of liquidity, but I think most institutions vastly overestimate. I'm speaking from the perspective of an endowment where, I think a lot of boards have this feeling that, but what if we need it? And so we've done an exercise where we've backed up and we said, okay, so what if you do need it, right? How much do you think you would need? Over what time period? And when you actually start to roll that back, the amount of liquidity that you need at the portfolio level is not nearly what I think a lot of investment committee or board members or leadership members of an institution think that they need. So that gives us a lot more flexibility to go out and find less liquid managers. But on the flip side, that illiquidity that we take on comes at a cost. And whether that's a cost of being able to pivot the portfolio if the environment changes, pivot from manager relationships if they're no longer delivering on what they are supposed to be delivering on. And so we've started to, or we've always, but I think increasingly started to think about, all right, what are we getting for that illiquidity? And this isn't just a, hey, private equity has an illiquidity premium, but if we look at our public equity portfolio or our hedge fund portfolio, and somebody's asking me to lock up capital, or it takes 8 quarters to get out or 12 quarters to get out, what am I getting paid? What am I being compensated to take on that illiquidity and to give up my optionality on the other side? And I think there's a fair number of managers out there who've had the ability to term out their liquidity because there's been so much competition for capacity, and they're not delivering on it. And so we've started to really hold our managers and our partners accountable for, we're happy to give you that illiquidity if we have it, But you've also got to give us something in return. We have to feel like that's a good trade-off versus a daily or monthly liquidity option that we have on the other side.
Makes sense. Darrel or Paul, anything to add?
Not a whole lot to add there, though. It's really critical for our organization, this concept of liquidity, and it's a balance that you're discussing where we get a lot of questions around, do we have sufficient liquidity? You know, we're a hospital system. We went through some serious stressors in the last few years. And thankfully, the portfolio did have sufficient liquidity for that. And there were other mechanisms that we can pull. But you go back and you reflect on what type of liquidity was available in 2020, or what type of liquidity was available during the financial crisis. Is substantially less than what you would normally see during a normal period of time. So we try and stress to those time frames and try to understand what our portfolio and liquidity looks like in those time frames, and combine that with operational needs that may exist. And use that as a framework for us before we start moving out the curve.
And I definitely echo Emery's comment on alignment, as well as what Michelle mentioned about challenging the illiquidity premium. Every investment opportunity is granular, and we have to take it on a case-by-case basis. So that's a lot what we do. And on the other side of this liquidity constraint is also on the overall makeup of your investment committee and the board, and the preference of the aggregate preference of the various individuals on how much illiquidity they are comfortable with. So that's something that we continue to work with our board and committee to communicate.
Darrel, let's start with you. What are one or two of the most compelling opportunities you see for your portfolio in 2025?
So I do think that, so we're coming from a different position than many on the panel. I think our privates portfolio continues to grow, in particular our venture capital component of our portfolio is on the smaller side, and we've continued to build relationships over the last several years and utilize kind of that time frame when many were not liquid to build relationships, and I think that's going to continue to bear some real fruit in 25 and in the following years.
Sounds like we've got a little bit of a theme from that perspective. We're also building out our privates portfolio, and so I think similarly, taking advantage of some of the constraints from some of our peers, especially in the endowment and foundation world, which has been massively heavy on the illiquid side, and so we've had the opportunity to step into some capacity availability there. I think the other one is, we have seen a major regime change, whether you're looking at interest rates, whether we're looking at dispersion among central banks, whether we're talking about banking consolidation and deregulation. And so really trying to look at those opportunities and figure out, all right, who benefits here? Who has strategies that can take advantage of high cost of capital in the existing system, or volatility over here, even in strategies that have been out of favor for several years. And so we're spending a lot of time looking at those dynamic changes and who we think the winners are.
Anne-Marie or Paul, anything to add on opportunities for this year?
So for us, I would say there's nothing groundbreaking, but there's a continuation of two themes that we've been in for a few years. One is, despite our size, we're actually big believers in smaller, particularly in private equity. So my team has to work harder because we don't write a lot of $100 million checks. We write a lot of 30 to 50s, and so we got to write more of them. But we just really like that space. We think the ability to impact the companies is just much more interesting at that level, and your exit optionality with smaller funds is a lot better. Because I actually really worried about what's going on in public markets and whether the IPO window is going to be really available to us in a meaningful way going forward. And then on the hedge fund side, we got involved about 1.5 years ago in a managed account platform, and it's been a fabulous experience with us. So this theme is similar in that we can partner with smaller managers and newer managers because we can see day to day what they're doing. So leveraging that transparency. And at the same time, there's a bunch of benefits from capital efficiency and other things. So that's been another thing that we've been very excited about, and we will probably continue to build that effort.
So we've been spending time thinking along the same lines of what Michelle is thinking about with the new administration. What are some of the areas and themes that may have been seeing a lot of challenges and headwinds previously, but now seeing a bit of a reversal. So obviously private energy is one of the areas that has seen a lot of headwinds since 2015, 2016, and that's an area that's now starting to probably going to be benefited from deregulation and the government's support on kind of drill baby drill in some way. And the other area that we have not placed a large allocation, but we're thinking hard about is obviously crypto with a new czar on crypto in David Sachs, as well as talks of potentially U.S. having a strategic reserve in Bitcoin, things like this that even though when you look across the U.S., you have about 26% of the population that have opened a digital wallet. To date, about 1% of institutional investors have actually had any exposure to Bitcoin in their portfolio. So we find that to be compelling, and that's something that we're spending some time on.
Very good. Let's shift. I think we've got time for one more question here. Let's shift to everyone's favorite buzzword, AI. Something happened yesterday in the market. I'm not exactly sure what, but I'd just be curious. We can go down the line. How are you using the technology to enhance your investment process? And have you invested in any AI-themed investments thus far? Why don't we start with you, Paul?
Sure. So my foundation actually has taken a more measured approach in adopting AI. We have recently drafted an investment policy or overall company policy on AI, essentially limiting the use of AI, asking people to present to their managers and have every tool reviewed and approved by our IT team before the organization can use it. So far, the first tool that was approved was Microsoft Copilot. So we've been doing some small things on improving our efficiency. For example, we are recording all of our internal meetings and asking Copilot to transcribe it, so we don't need somebody to take notes. We are doing trying to establish an agent to essentially taking all emails from prospective fund managers and help us summarize that. And we are thinking about finding ways to customize our response based on what the agent analyzed with the prospective fund managers. And lastly, taking unstructured manager data from presentations, from PPMs, and trying to organize them into our internal format for our ODD templates.
Anyone else? Anything AI?
So it's interesting that you're using AI to take notes. We actually are not, and I would love to, but we have this little thing called FOIA, and we really don't want all of our internal conversations being discoverable. So if somebody's got a legal response to how to figure that out, call me. So that's one thing I would say. Second thing I would say is we have actually had a lot of concerns about, so I probably get about 300 quarterly letters. And needless to say, I don't read all of them. Sorry if any of you are in the room that send me one of those. But what we'd love to do is have AI read them and summarize themes or what's changed. But what we've had to put in place the infrastructure to make sure none of that leaks out into the broader internet. So we're still in the constructing phase, but we're very excited about what the opportunities could be once we can kind of establish the security that we need. And then on your question, we did do a bunch of our venture funds have various flavors of AI, and then we just actually did one dedicated AI fund. So it's 3-month-old, so we don't have any results yet, but we're hopeful.
You know, I think the security concerns that you talked about have been top of mind for us as well. You know, back on we ask for a lot of transparency from our managers, and we want to make sure that we're good stewards of that information. I think there are increasingly available options that do ring fence the data pretty well, but we're still in the process of testing those. So for right now, we've put kind of a moratorium on new tools, but we're constantly looking for great options. But I think this goes, and this feeds into the investment side of it, which is there's a lot of use cases that are being tested, and we're seeing this across our investment managers, whether it's on the public side or the venture side. and there's some big questions, or the data center side, right? There's some big questions about what the capacity needs are, or how those use cases pan out. I mean, I was having a conversation with somebody who said JP Morgan has 300 different use cases right now for AI, and nobody has any idea whether the hit rate on that is going to be 50% or 0. And so I think, as we're talking to our managers and trying to understand how levered they are to corporate adoption of AI, we're trying to focus more on areas like cloud infrastructure and things like that, which have more near-term opportunities, and then relying on really our venture managers to take those longer-term views on AI.
Well, we are out of time, so please join me in thanking our panel for excellent insights.